Hello, everybody, and welcome to the Like a Tortoise channel. I am very happy to have Ty join us today for an amazing interview. And I want to say, Ty, thank you so much for coming onto the channel. Ty, for those of you who don't know, and if you are part of our WhatsApp group, then you know that I already shared the link of his YouTube channel. Ty has over 25,000 followers on YouTube. And one of the reasons that I'm one of them is because I got attracted to his content a few years ago when Ty started buying Alibaba. And I remember that at that time, this was probably 2 years ago, I even reached out to him on Instagram to ask questions about Alibaba. And so, I just sent him an email actually I sent him a message not that long ago, and he was kind enough to come back to me, and he agreed to have an interview here and sit and share a lot of his value with us. So Ty, thank you so much once again for coming onto the channel. And I know that we will have more opportunity to delve deeper into your framework and track record as well. But some of the companies that you own include, for example, Alibaba and Lululemon. These are the two of which we are also shareholders of. And so, but before we do that, it's nice. Would it be nice for you to give us some idea about your background and investing origin story? Is that okay?
Sure. Thanks. The pleasure is mine, Ed. So I think I always enjoyed many of such discussions with like-minded people. And that is also one of the main motivations as why I even put myself out there. I think I've been on YouTube for close to 4 over years now. And I think throughout the entire period, I received a lot more than I have given in terms of sharing, in terms of connecting with people, and just in general, getting people to check my blind spots, because we all know we are failable, we were unfailable, or we were failable creatures. And it's good that we have a whole entire community of people looking at things from different perspectives as well. So that's my own, in a sense, how I've progressed as a so-called quote-unquote influencer, or whatever you want to call it. But coming back to the point, as to your question, as to my own personal background, so I've graduated from university roughly 3 years ago. So I did a banking and finance degree. So okay. in a sense, I am kind of doing things that are in my discipline. And before that, I've already started creating content maybe 2 years in. So in year 2 or year 3, when I was studying, I wanted to apply what I learned in the classroom, because we all know that a lot of things that we learn, it's in theory. The professor is in front, he's lecturing, he gives you hundreds of pages of notes, but those things are just calculations, they're just mathematics. Right. But what really is important, especially if you're in finance, is how do you make money? How do you make money grow more for you? How do you pick good businesses? How do you weather through drawdowns? Those things they don't teach you. Yeah, they teach you compounding, they teach you your weighted average cost of capital and things like that, but that doesn't necessarily translate to you being a good investor. So at the same time, I think while I was trying to acquire those kind of like book-related knowledge, I wanted to apply what I've learned. And also, thankfully, at least since young, my dad himself is also an avid investor. And because of investing, he managed to retire relatively early. So that really made me, or kind of inculcated into me that, hey, this is quite a good vehicle in terms of study, and also in terms of how it can help you in terms of financial life. So I think one thing led to another, and here I am, and that's where I basically landed with this entire small side hustle on YouTube, if I may say so.
Fantastic. And I know that, you've been sharing a lot of content over the past few years, and a lot of it is just great content. And it's going to be interesting as well. So, for example, you know that you told me that, just tell us that you told us that your father, he was an investor as well, and he was actually able to retire fairly early. Yes. Did you learn as well? Did he pass his framework down to you? Yeah, so did you pivot your strategy at one point? So, for example, as I was discussing off this call, I started as a trader, but then I pivoted towards investing, and I actually found it less stressful and at the same time more profitable. How did that your experience initially shaped your current framework?
Right. I think the context here is pretty important, because I think back then when my dad was, while he was working and also building his career and also investing at the same time, the context is this, because based, I think back in the 80s, 90s, when he was in the Singapore market, even until today, he only operates primarily in the Singapore market. So
Okay.
there are different characteristics as to, I believe if you look into the European market, maybe it's probably a lot more similar than the US because it's based in the Western markets. But specifically in Singapore, it's a lot less liquid. There's a lot less volume. And the way you look at companies are pretty different because of the general gist of companies based in that are dominating the industry itself. So you have mostly your financial services and maybe a lot of REITs as well, your real estate investment trusts. Very far cry from your tech companies, how you understand what is an economic mode and things like that. Things, yes, you can kind of justify that. If you look at a bank, there are certain characteristics of an economic mode, but not so much in the very modern sense, if I can put it that way. So if you're comparing in terms of framework-wise, yes, he did kind of impart to me in terms of what is a business, how do they generate revenue, a little bit of accounting here and there, but I did most of my learning in school. Plus, yes, I think we have talked about it before we start the call. We are all great students of all those great investors like your Buffett, your Munger, Peter Lynch, and things like that. So we kind of took a bit here and there, and I've kind of modified my approach. But coming back to your point, I didn't start off as a trader because I think I was just naturally not very exposed to that school of thought. So when I started out already, my dad has inculcated to me, I really love enjoying sharing this story. I still remember when I was quite young. I think I was like close to 10 years old. I was in primary school. We walked into McDonald's and McDonald's was my favorite breakfast of all time. I really loved it. I can go it every day, but of course, due to health reasons, it stopped me. But anyway, when I went to a McDonald's, we were all focused on just enjoying the breakfast itself. But the thing is, my dad sometimes will just remind me, hey, think about it. What is actually McDonald's made of? They're selling you burgers. They're selling you probably sometimes pancakes, hot cakes, things like that. And he just wanted me to kind of observe my surrounding into understanding how much money, just to make assumption or guess, how is McDonald's making money? What does it mean to have margins, running a business, counting customer flow and things like that? So I think from there on, you start to build up different ideas of what businesses mean, how they actually earn money, what is a profit, what is a healthy margin, different industries. And then whenever you look at different businesses, especially when I travel today, I also like to do this kind of like customer counting, how much what is their turnover and things like that. So it gives me a better flavor or just a different vantage point when you look at things. So that's how I really built up from there at a very young age, based on the influence back then. So yeah, that's how I do it.
I love that. And so, for example, at Like a Tortoise, you mentioned about the fact that we indeed base many of our principles and methods from some of the world's best investors, right? Peter Lynch, Warren Buffett, some of the names you mentioned. Yes. It's interesting because then what I did is, after reading so many books on these great investors and the performances over decades, I just tried to incorporate a lot of those teachings into a core framework. And that's how Like a Tortoise was born. And the goal, what we try to do is we try to build portfolios comprised of high quality companies only when we have a big margin of safety.
Yes.
Now, we also believe in following a very concentrated approach to investing. And this is something that I want to ask you about as well. So how do you think in terms of concentration versus diversification? And please, if you can.
Right. I think I don't have a set criteria on that. I do understand that there are very valid arguments for both sides of the camps. Okay. I think on one hand, of course, your very great investors or legends like people like Dalio, he's a big proponent of diversification. He talks about uncorrelated, getting the highest risk-adjusted returns and things like that. And also, I think some pretty good investors, if I'm not wrong, Peter Lynch back then, he had a crazy amount of CAGR. But at one point in time, he had thousands of stocks.
Thousands of stocks.
Yeah, so in that sense, right? But of course, you have people that naturally, intuitively, you want to kind of concentrate your best ideas, because why would you want to bother allocating to your third, fourth, or fifth best ideas? So I can see where both sides of the camps talk about it. For myself, I think it's a function of two main factors. Number one, it's the function of a conviction. And number two, it's the function of your capital. So I can share in my own approach or my own background is that when I started out really early on, I was managing, say, the low 5-figure marks. So at that point in time, let's assume that, let's say you have $20,000, $30,000. Even if you were to say that, oh, it's a good rule of thumb to hold 10 names equally weighted, meaning to say 10% of your portfolio allocated to 10 names, so that at least you have some levels of diversification. That means you allocate $2,000 per name. Even it gives you a multi-bagger, I think it's not really going to move the needle in terms of your comprising of your entire net worth of your portfolio value. But I think when you start to move up the chain, and then let's say you start to move up to, let's say, $100,000 to 500 to $1 million to multi-million, then I think it kind of acts as some level of prudence. Even though that said, yes, I do agree that there are a lot of investing legends that are managing hundreds of billions of dollars, and yet they can put like 20% as their top position. No doubts about that. But I think it's really where you're comfortable or where you sit on this kind of equation. I don't have prescription per se, but that's it for me. I think my two largest position, like let's say Tencent and Alibaba, it's at 50% of my portfolio. So who am I to judge on whether you want to concentrate a large part or not? I think it's a very individualistic, and it's what makes you sleep better, and how you're comfortable with allocating your portfolio. Yeah, that's my view.
I love that answer, and I feel exactly the same way. So, for example, I have no problem concentrating into 7-8 names, but I completely understand how temperament varies, like from one person to another. And so for some people, I mean, they wouldn't be able to sleep comfortably with that level of volatility, because that's the price you pay for running a concentrated portfolio. You will see a lot more volatility, because if one of those names goes up 30%, it will drag the performance of your portfolio along with it.
Yes.
And so, that makes complete sense.
Actually, on the side, can I ask, how's your portfolio? If you don't mind sharing in terms of percentages, how concentrated are you sitting in?
Okay, so Alibaba, my largest portfolio allocation, I started buying it around $74 per share, because Alibaba just went sharply higher. Right now accounts for about 30% of the portfolio. Right. So it's your Alibaba and the Tencent combined. You said Tencent or JD?
Yes.
Sorry, Tencent.
Yes.
Yeah. So and yeah, exactly. And then now the main question is, and you have many videos about this as well. Should I sell Alibaba? Even some of the people that commenting on your like in your videos, I sold Alibaba. I was sitting on like in a lot of cash. I mean, on a lot of profit, so I just decided to sell. There's not there's not just a unique way to go about this. Again, it comes down to your temperament and having that framework and sticking with it, right? Yeah,
I think the largest question that really there isn't any right answer to this, because it's a very individualistic kind of.
Exactly.
You are the active manager of your own portfolio. But what I can tell you is what I'm doing. So personally, I'm still holding on for quite some time. And yes, we've seen some levels of retracement from its recent highs. But that said, I think this year, 2025, especially for investors that have held on for a very long time, it's a pretty good year. Let's not put it aside. I think when we were down, people were ridiculing and thinking that it's uninvestable. But I think in 2025, we have to kind of like give ourselves a pat on the back that, it has recovered by a very large extent. But coming back to the point on whether to sell or not to sell, the analogy is pretty simple. Because if you're to ask yourselves that, if today Alibaba is, let's say, depending on how you estimate and how far you look at, people like to toy around with the idea of what is the intrinsic value of the business, right? They think that they try to discount the future cash flow discounted to a discount rate. That said, it's true. That's one way to look at it. But the second part of the discussion is also in terms of what is your time horizon. And if you do have a very, very long time horizon, and you believe that it's one of those so-called compounders that you've seen many great US companies has went on to compound, if you think about it in a very, very astute way, it will be kind of like, if you believe in the entire AI cloud build out and things like that, it will continue to compound at a very, very significant rate in the far out future. But that's, of course, if you have a very long-term horizon. But for those of you that are like maybe coming in for a punt, you think that it's from undervalued, it's now going back to fair value, and if you to sell, I think there's there's really nothing to say that that's wrong, because at the end of the day, you still make money. So that's the ultimate goal that we want as investors. But coming back to my point for myself, if I'm taking let's say a 5, 10 year, 15 year view of the company, and I do believe that it's one of those huge and great compounders sitting on great tailwinds, and it's still so-called relatively undervalued, then I don't really see I don't have any push factor that is pushing me out of the stock. Maybe there might be potential other pull factors, like I identify better opportunities and I wish to reallocate or rebalance.
Exactly.
That's probably maybe one of those reasons that I'll sell. But for now, I think I'm just sitting quite comfortably in the position.
I love that. In fact, for example, it reminds me of another position in our portfolio that I was reassessing yesterday, and that is Alta Beauty. I started buying the company around 340, and now the company is almost at 600.
Right.
And so the intrinsic value, in my opinion, has been reached. But the question now is, should I sell? Should I hold on to it? Do I think the company is going to continue to compound over the next 5, 10, 15 years? And so I think a core value investor would exit immediately once the fair value is reached. But then this is where the quality investing as well comes into play, right? Because indeed, Buffett taught us that the best time to sell is almost never.
Yes.
And sometimes you have these gems, and they will continue, especially if they are riding great tailwinds like Alibaba, for example, is in multiple exits, cloud, AI, e-commerce. It makes sense to try to let them run, right?
Yes.
Yeah. Fantastic. Right. And how do you determine whether your thesis is broken?
How do I determine whether my thesis? That's a good question. I think I've recently had a conversation with a fellow investor as well. I think before that, we should take a step back and to ask ourselves, when we, let's say, buy a stock or the general investing principle is, you are buying a part ownership of the business, and then you're expecting the business to be well run. It will compound at an internal rate. And usually in the very, very long run, your stock returns will follow earnings per share. I think all these are general principles that we can agree on. So coming back to the point on whether your thesis is broken or not, I think first things first, for myself, I think it's a little bit special, because coming back to your framework again on how you look at investing, whenever I like to buy a stock, I like to buy when it's in bad news or in negative news territory. I don't like to buy when a stock is up, let's say an all-time highs or like near all-time highs. So whenever I look into a company specifically, they tend to already have a drawdown of close to, say, 30 to 50% from its all-time highs. And naturally, the market, I don't believe, is stupid. In a sense, yes, I do agree that sometimes markets can be irrational, but when they're trying to price in something, or when the stock price is down, it means that they are intending to price in something. So I'll give you an example. A lot of the software companies today, they're all heavily beaten down. Your Adobe, CRM, Constellation, and things like that. So I've seen quite a lot of them taking a beating. And I've also seen you cover some companies like PayPal and companies that really, in the value investing community, people love them because they are like at all-time lows and 52-week lows and things like that. So coming back to the point, when you are buying into it, my friend did kind of joked with me. He said that, what gave you the arrogance to kind of think that you're right while the rest of the markets are wrong, right? Yeah. Because everybody is telling you that you're wrong while you pushed out. And of course, when you look at your own track record, there are names that are right and there are names that were wrong. So you have to take the humble pie into thinking that, yes, there are sometimes theses that play out and sometimes theses don't play out. I think that's the entry of the game. So you have to acknowledge that. So coming back to your point on whether you think a thesis is broken, usually how I position myself, or when I look at businesses or stocks in this case, is that I don't need them to really outperform. Because the assumption here is just, if they can hold on to certain market shares, hold on to certain growth rates, multiple just re-rate a little bit, you tend to get your 12-15% CAGR that you're looking for. So that's the first level. On the second level, what about value investments becoming value traps? Meaning to say, like, the business can just be performing well, but maybe the terminal multiple or the exit becomes permanently impaired. Maybe, like, for example, I think one of the main concerns about Adobe today with the AI threat and people not needing the design, the needs of design. I only can tell you that a lot of these kind of things we can only know when it will happen very slowly and then very quickly. That's my personal take after starting this investing thing for some time. But one important thing is, if you already bought it at a very, very huge margin of safety, you're not going to lose 100% of your capital. True. Maybe it will tank for another, say, 20, 30, 50%. Maximum that I've seen Alibaba from my entry point to the bottom was 70%, but it's a little bit different because they kind of like recovered. It was in a very broader general bear market. But in a very, very general broad sense, is that if you buy into a generally good, okay company, it might not recover, but you would not lose too much as well. So that's the thing. In terms of whether the thesis is broken or not, I think it comes back to, I don't really like to monitor market movements, meaning to say if the stock price is down 50% from my entry, it doesn't affect me. But what it does affect me is if the company start posing earnings, quarterly earnings after earnings, that it starts to continuously contract, margins continuously continue to contract, revenue starts to go negative for multiple quarters at end, and it goes down by a very, very large extent. Not those, like, let's say, flat revenues or even like be -2, -3. I would be extremely concerned if they start to post year-on-year kind of -10, -15 kind of returns. And my idea is very simple. Because at the end of the day, I pay a lot of attention to balance sheet as well, because that is a very important. If I can outlive the company in a sense where if they don't need to constantly refinance, that's also fine with me. Because let's not forget, one of the superpower as well for a lot of all these value in stocks is they can keep buying back shares. And I think this is a very, very underappreciated kind of like superpower, because people don't. Okay, let me just give you an example. I believe it was one of the investor, was Monish Pabrai or something. He was sharing this concept of when you think about a company just maintaining top line, if they can maintain their margins and they just buy back shares at a very, very
Monish Pabrai. Yeah.
Yes, Monish Pabrai. If they are able to wipe out 50% of their outstanding shares, means that the share price will double. Yeah, because assuming all things equal. But the real superpower comes in after the 50% mark. So if they wipe out 75% of the shares outstanding, means that the share price will quadruple, because you 25% on the base of 100. And then you start to bring in the numbers of wiping out 80%, wiping out 85%, wiping out 90%. Then the numbers start to get really ridiculous. The worry now is whether on an earnings per share basis, or in terms of whether they're able to maintain the market share or whether they're able to maintain the margin. I think that's the bigger concern. But if they're still a very, very highly profitable business, with them being able to secure what they've did over the past, then that's not necessarily a concern, because they can just keep buying back their shares. So that's how I look at some of this moving parts in investing.
Yeah. Love that. Yeah, and that was part of what attracted me to PayPal, is the fact that they've been buying. Number one, they have now a new CEO, Alex Chris, and I think the management team has delivered on the execution plan that they laid out when he started the role about a year and a half ago. They've been relentless when it comes to buying back shares. Yes. And but the company is just clocking in ridiculous amount of free cash flows. Yeah. So in fact, it's still a business that is not stagnating; it's growing. So I mean, yeah, that was part of my thesis initially as well. So it's great that you mentioned about the erosion of margins over time, and that can actually break a thesis. I'm curious though, because you and I know this. Alibaba's margins are now they have deteriorated a lot because the company is just going through a capex heavy environment, right? So they are investing a lot into AI, quick commerce, and so the metrics don't look great. I mean, we saw free cash flows going almost negative in the last quarter. So I mean, I assume you would be paying close attention to that over the next few quarters, right? You want to see the returns on capital, right?
Yes. I think for that specifically, it's of course it's always a standalone kind of special case.
Yeah.
Of course, there are general principles that you follow, but I think specifically for this Alibaba case, it's quite interesting because it turned from initially before we went in a sense that if you identify as a value investor, it was considered a growth investment. A lot
Yeah.
of the early investors that went in the 2016, 2017, when they bidded up the price all the way to 300, it was a growth investment. Cloud was growing at 30% clips easily before the entire crackdown and the slowdown of the Chinese economy. The growth of the e-commerce was also well. They were expanding the business very aggressively with acquisitions. But I think in the meantime, while they were doing a lot of those, margins actually also went down because of so-called, you could attribute it to mismanagement, expanding into bad industries and things like that. But at least based on how we have seen it, margins should continue to at least kind of stagnate or even improve as they kind of disposed a lot of the previous investment that they did. But coming back to your point about now, when we look at things like free cash flow, because of CapEx, I think there are two parts to this, right? One is in terms of maintenance CapEx and one is growth CapEx. Yeah. So for one, I think when we look at a lot of all these companies, not only Alibaba, all your US big tech that are in the same space, your Meta, your Amazon, your Google, all of them are throwing tens of billions of dollars into CapEx. So I do feel like my general sensing now is that a lot of things are quite uncertain. But people, or at least investors right now, are willing to sign a blank check because they believe that this is going to be a game changer. And myself included, I think all of us can agree that this entire AI build-out endeavor is going to be a game changer. How do we calculate the ROI or the ROIC on this? I think your guess is as good as mine. I sit through all the different earnings call from all the best tech talent out there. None of them can give you a satisfactory answer. Exactly. They only can tell you that, oh yeah, demand is high. When we build out within the next 2 to 3 months, everything is done. But is it sustainable? Are we in a bubble? I think I'll leave it as a question mark for now. But we could potentially as of the time of this recording, we could be in a bubble, as we all might know. But the key here is really, you only can tell a bubble after the entire thing burst. Then when we look back, you had hindsight 2020, and then you had some semblance of understanding whether we're in a bubble or not. But for now, coming back to your point about Alibaba, they are building one of the most foundational layer that is important. It's a huge tailwind ahead. I think no doubts about it. Like maybe the e-commerce arm has really started to mature. Now they're sitting on the second, as Tesla investors like to call it, the S curve. And we're not only talking about just cloud with that coupling of AI as well. So with just these two tailwinds alone, I think it would bring it to a much bigger enterprise, a much more important cornerstone of the entire digital economy as well. So on that very general broad note, a lot of investors now, I think they're closing one or even sometimes closing both eyes into saying that, okay, go build it out first. I just want to monitor metrics of how long does it take for you to fulfill demand? Is a lot of what you're building actually fulfilling something that an end customer to help them improve their productivity? Are you bringing in revenue? Are you growing it at a fast enough clip? I think all those for now, especially coming back to the growth investment side of us, is that, okay, I think these metrics are still pretty healthy. They are progressing at a relatively good pace. So I'm fine with it. In terms of like optimizing for margins and things like that, I think those will come down the line. So if you look at the investment case itself, it has pivoted from a growth company to a value company, then back to a growth company again. So exactly. Yeah, I think it's natural for a lot of all these so-called tech-related companies to all naturally be able to become growth companies in a very long term as well, because of this huge tailwind ahead.
Exactly. Yeah. And this is where management comes into play, right? And yes. I like what the CEO of Alibaba is doing, Eddie, and also the chairman, of course, Joe Tai. I yes. really love listening to him. And yeah, so, I mean, we will see what's going to happen. Yeah. But now I want to talk about Lululemon, because I know you are also an investor in this company, and people in yes. our community have also invested in the company. What drew you to this company initially?
What drew me? No doubts. Actually, to be frank and to be transparent as well, it was not a company that I would usually look at, because I if I wanted to buy, I do love luxury companies, don't get me wrong. So I love companies like LV, which I do have exposure.
Me too.
And I love companies like Hermes. But I don't own Hermes, unfortunately, because of valuations and things like that. So I do like a lot of all these so-called like luxury brand positioning, brand mode kind of company. But when I look at Lululemon was kind of like in the premium category. So it's not necessarily like luxurious because they're not selling yoga pants that are like $1,000. So it's in the few $100s range. And a friend actually pitched to me this company. He was pretty bullish and he was talking to me, like constantly talking to me. And when I looked through the entire investment case, that was when it got me really interested when the share price really got punished very, very heavily. And I think the general sense is there's a deceleration in terms of growth rates. There's some sort of maturing in the Canadian and the US markets. But the China growth story is still pretty much intact. And I think one important thing is in terms of the execution of Kelvin, I believe. It was Kelvin McDonald's. He did a power of three and then the doubling, and he did deliver on both of his main vision. But I do kind of, there is on one side, of course, I like to be bullish, but there is a concern about them misstepping for the last few earnings call. He first came out talking about color assortment. After that, he pushed out different colors and he said that, might be a design issue and there were some movements in terms of senior management. So for myself, I look at the valuations today that the Mr. Market offered to me. I thought that the risk reward here today is pretty interesting. And how I did it was I don't necessarily have such a high conviction on Lulu compared to the rest of the names. So I sized it accordingly. So It's still a sizable enough bet, but I'm not betting the entire farm on Lululemon, and I'm just giving myself certain exposures and just allocation for it to kind of play out. And it's kind of like the situation of heads I win, tails I don't lose much because of the margin of safety that it allows me. And when I kind of triangulate the data on my side of the globe, because I do visit China quite a bit, I think when you pitch Lululemon against the rest of its other counterparts, they still do have a sense of superior positioning. People are still buying things away. Usually when you look at different, like in a store, you compare Lululemon with the rest of the other athleisure kind of products, and even to your big companies like Nike and even Adidas, usually their stores are empty and Lululemon is full. So that's a little bit more of a scuttlebutt kind of investing approach when I compare it across industries. So I think the Asian story for now still looks relatively intact, which is kind of driving the growth and at least trying to eke out a low double-digit kind of growth. But it's really the Canadian and the US side of things that they have to kind of iron out their operations and things like that. So for now, I'm kind of still backing the horse that the Asian story is still intact, which I see in my side still looks okay. But if that side of the bet is also starting to slow down, then that would be a major concern, because then Lulu will start to stagnate in the very broad sense. So that's how I look at the company today.
Fantastic, yeah. And I remember watching one of your YouTube videos where you talk about the fact that you visited Lululemon stores and even some of competitors. You talked about that. I loved it.
I think that's I think that's generally, I think from young, actually from our earlier discussion that I've alluded, that is one of the main ways of how I like to look at these companies. And even I'm a customer myself, by the way. Full disclosure, I like the Lululemon pants as well. But coming back to the point, I make it a conscious effort that whenever I visit a lot of all these places, I try to, especially if it's more retail facing or more consumer facing kind of businesses where I can have a general vibe check. I like to go through their places. My main market in Singapore is too small. It's not going to move the needle. But if you look at bigger markets, when you visit China, you go to the bigger APAC region, I think those are the ones that will give you earlier onset into understanding how consumers are thinking about the product itself. Yeah,
exactly. And in fact, I went to two of their stores in London, and they were actually packed with Asians. And I started asking them questions. Hey, do you like Lululemon? What do you think is the main difference between Lululemon and Alo Yoga? And I asked them straight away. And what they told me is that what I understood is that if you are someone who really likes exercising, there is no other brand like Lululemon in terms of comfort, in terms of so the gear that you use is so comfortable and it really allows you to perform at a great level. That's the explanation they gave me. But now we see all celebrities wearing aloe gear, for example. And so you mentioned the Americas, the Canada and United in North America. In fact, that's still over 70% of the revenue. So I'm going to be very interested in learning over the next few quarters if they can turn that business around there, because I want to see some acceleration, of course. Now that internationally speaking, the business is going very well.
Yes, I think a bigger concern about now, from my understanding of when I look through the earnings, I think it's good that they admitted that the color assortment and how they look at the problem was wrong. But I'm more worried about maybe in that sense, it feels like this is based on how I read between the lines. Maybe the Western side of the consumer is a little bit fatigued in terms of like the design, innovation, the products that they're pushing out. The cadence of the product refreshment is not fast enough. So I'm also looking in terms of how they are kind of targeting or focusing on the right problems in that sense, rather than, but at least they recognize the problem already. So ultimately, it's still an executional thing. For now, I think we do give him the benefit of doubt because he has delivered over the last, I think, 6 to 8 years. So we'll see how things go. But business is dynamic, especially in investing as well. It's dynamic. So I keep an open eye because I'm not necessarily so-called married to the position. But I do think in terms of the risk reward here, why I still went into the company was mainly because the risk to reward in terms of upside here is quite humongous if they are able to turn things around. And just you can crunch in any numbers that you like. Lulu is clearly kind of like so-called undervalued unless there is significant deterioration in their core business. So that's one. And of course, not forgetting that I think a lot of all these companies in that space, I think Nike and there are mismanagement as well. But tariffs has also been a very big so-called talking point that will hurt the margins and 100, 200 basis points. So I think everything is in a flux now. And it's exactly because in times of uncertainty that Mr. Market tries to price in a lot of all these things. So if you do have a longer term trajectory or longer term view in how you look at these, it might be opportunities. Also dependent on whether you have the conviction and you study the business good in depth enough to make it a sizable enough position or not. So that's my view for that.
Makes sense. Yeah. I want to transition now into macro, and so based on my understanding, you are definitely you pay attention to the company itself, like us, and we try to zoom out as best as you can, try to zoom out market noise. And one of the main difficulties that I have with some of the people I'm coaching, for example, is they can be too temperamental. And sometimes what it does is you make impulsive decisions that can greatly impair your long-term results. And so what can you tell them? What's based on your experience so far? There is FOMO. Every day there is something going on. The markets are going to crash next year. This investor just sold off his shares. How do you zoom out all of that noise?
I think it's a very tough question because it goes back down to human psychology and behavior again. It's very hard to rewire somebody's innate tendencies. So I do believe that some of these so-called great investors, they're just born with a unique set of genetics that enables them to kind of tune out and ignore and to just focus on things that are like the signal to noise ratio. And a lot of all these macro tend to kind of be categorized under the noise side of things. But coming back to your point, rather than try to kind of prescribe them some sort of a biblical verse into understanding that, you should follow thou shalt not, things like that, I think it's more important for them to turn their own perspective into understanding it from their point of view. So to give you an example, I think an exercise that is very important when you like to listen to all these so-called macro predictions is I think you can write it down, meaning to keep a journal, into understanding what made you cost. So for example, write out the macro event. What did it cost you to feel, meaning to jot down the emotions, and what was the ultimate action that you took? And once you write down or screen through a lot of all these kind of decisions, then you'll kind of realize that what is that signal to noise ratio in terms of whether you're a lot more better off listening to these macro signals versus just focusing on the long term and just focusing on the business fundamentals. Because there is no point of us trying to constantly sometimes you're there, sometimes you're not. So they can rely on you today, but maybe 3-5 years later, for whatever reasons, they're not with you anymore. Then they'll revert back to their old ways of doing things, especially in the investing world. So it's more important that they have that kind of self-discovery journey and to understanding what works and what didn't. And they have to have that mindset shift internally. It cannot be externally driven, because whatever you say can work for a while, but they have to believe it fundamentally.
Agree.
So coming back to the point of, like, if you jot it down and you go through all these, if one set of evidence is not enough, you can do it for another month, another year, another 2 years, another 5 years. There will come a point in time that they realize that a lot of all these things, net, they might not be better off listening to a lot of all these like FOMO or whatever, talking about recession and going out of their positions, compared to somebody that just buy and hold and just ignore and tune out all these noises. So that's how I think about it when I'm talking to people like that, especially.
I have one last question for you. Yeah, sure. It's like in this, I think I've heard people like people give different answers, but I'm curious to hear your take on it. Do you think that in order to be, I believe it's a misconception that in order to be a good investor, you have to come from like a finance background. Okay, and I wouldn't go as far as Bill Ackman as far as he went when he said you can be a great investor just by reading books. I think you will need a bit more than that, but still, how do you see this?
How do I see this? I think this is a great question. In order to I believe, I mean, if you look at it empirically, based on just numbers and data, the greats, the goat of investing, right? Buffett himself, he doesn't have a CFA. You think he's intelligent? I think he's intelligent enough, but is he the smartest? I think he got rejected from Harvard as well, so did not make it into one of the best so-called Ivy League schools in US. But he still, what made him so powerful, or what made him so much better than everyone else, is, fun fact by the way as well, side note, is if today Berkshire drops 99%, it still outperforms the S&P over the last 60 years. Yeah, exactly. So just put that in. I think the bigger thing here is a lot about consistency, keeping yourself a craft, constantly honing up your craft and knowing your circle of competence in terms of how you're competing in the space. No doubt it's a very, very competitive space in investing because you have so many smart people throwing so much brain power into this beast here. But at the same time, I think the other part of the investing, you need a certain level of intelligence and I think more importantly, interest in the game itself, because it's a very, very competitive space and you need to keep reading up. I think once the entire AI macro thing started coming in after 2020 ChatGPT, we all have to start to understand what is large language models, what is token utilization, a bit of infrastructure, what is cloud, and what is all these AI thing going on. You need to have a lot of interest in that, but does it mean that you have to go into the nitty-gritties into understanding exactly how a large language model works to become an AI researcher? I think you don't have to go to that extent as well. But the second part of the equation that is also important is a lot about the whole understanding thyself, a lot of self-awareness, a lot of controlling your own emotions, being disciplined, not to be too pulled away in one side or the other side, not to be too fearful, not to be too excited, don't have FOMO and things like that. So I think it's a kind of a very unique blend and mix of things that you need to be in order to be a good investor. So coming back to your point about is it important to have a finance background? Personally, I don't think so, because I do see a lot of great investors in my own circle or in my own network that they all don't have finance background. But I do believe that you need to have a good enough interest. And also, I think the second part is a lot about self-motivation and self-discipline in that sense. So that's how I look at it. Yeah.
Yeah. And I think, that will certainly go a long way in helping our audience understand exactly how they can also focus on the long term in order to prevent a lot of those impulsive decisions, right? Because
Yes.
in the short term, we compete with a lot of people, but then over the very long term, we are not competing with that many people, because all these asset managers, for example, typically tend to have a very short-term orientation, right? So, I mean, look, I mean, thank you so much for coming onto the channel and for
Yes.
sharing your great insights and personal experience. And for everyone watching, I will be sharing Ty's YouTube channel with you all, so you can follow him. I think his content is just amazing, and you will see that he's all about, as you already explained to us, all about holding great companies for the long term, and many of them we are invested in. So it's nice to see that we are aligned in that regard. Is there anything you'd like to share, Ty? Maybe a bit more about yourself, just to wrap things up.
I mean, I think it has been a great conversation. Thanks for asking great questions as well. And I think it kind of made me think a lot more in terms of how I look at some of these very questions that sometimes we don't even think about. So yeah, I think it has been great, and thanks for extending the invite as well, Ed.
Thank you so much, Ty. You have a great day ahead, and speak soon.
Thank you. Okay, bye.
Bye.